Welcome to my presentation for the 21st INFER Annual Conference. I'm Bashar Fakhri. I will be presenting the paper aptly called Happy 20th Birthday Euro, an integrated analysis of the stability status in the Eurozone's equity markets. In 1999, 11 European nations adopted a new currency, therefore unifying their monetary policies. This presentation will look at the impact of this event on the financial market with a special emphasis on the integration of the equity market, and the impact on the stability of the market, over 6 different periods between the 31st of December 1997 to the 31st of December 2018. We follow the convention by firstly reviewing the research aims and contributions in the introductory section. We then review the literature on the Eurozone financial markets integration. Thirdly, we evaluate the methodology of the model specifications of the ABEKK and GARCH and our multivariate volatility test. Fourthly, we review our observed data. The fifth section provides our empirical evidence on the stability of the Eurozone integrated equity markets, analyzing the volatility spillover effects and impact of contagious news over 6 periods during the timeline of the euro. Closing with the conclusions and recommendations. Although many papers have been written on the impact of the euro on the integration of the financial markets across the Eurozone during the introductory and crisis periods. Moreover, there is an extensive library of research on the impact of the euro on the volatility spillover affecting contagious impact of news within the Eurozone. Yet a key issue remains understudied. The stability of the Eurozone markets, which was highlighted by the recent financial and sovereign debt crises and extended by the recent rise in the populist political movement, such as the Brexit process or rise of populist political parties, which puts into question the whole concept of European integration. Therefore, the main aim of this research is to analyze the impact of integration on the stability of 11 Eurozone equity markets, in the aftermath of the introduction of the euro over 6 different periods. Furthermore, evaluating the impact of 2 key factors in the integration of the equity markets, volatility spillover and contagious news. Our key contribution to the literature on financial econometrics is the extension of the volatility test of Fakhri and Richter 2016 to a multivariate volatility test using an ABEKK model. This would allow us to test the stable market precondition hypothesis, as proposed by Fakhri 2019, in the context of the multivariate environment. Therefore, additionally analyzing the environment underpinning the transmission of volatility and news from one market to the other within the Eurozone integrated financial market. Although the ABEKK has been used to analyze the transmission of volatility such as Wang and Wang 2005, Li 2007, Efmova and Salitais 2014, Imenik 2014, yet mainly due to the complex nature of such a model and estimation issues, the ABEKK model has been sparingly used in the context of the Eurozone financial markets integration. Economic theory dictates that the integration and development of financial markets are key to economic growth. Financial integration could affect the structure and hence stability of the financial system. Relatively few, such as Feldstein 1997, questioned the enthusiasm towards the euro. Dunfine et al. 2000 and Trige 2001 found the euro had an impact on the financial market in the early years. However, Galati and Zatsaranis 2003 found the impact was uneven across the financial market. Baele et al. 2004 found evidence hinting at an increasingly integrated equity market. However, Cappiello et al. 2006 and BEKK et al. 2013 found the equity market wasn't as integrated as originally thought, and the euro did not have a strong impact. Much of the recent empirical evidence on volatility spillover and contagion have concentrated on the Eurozone sovereign debt market during the crisis of the late 2000s to mid-2010s. Good examples are Misio and Waitska 2011, Favero and Missel 2011 and Gruber et al. 2013. Bilio and Belyson 2003 found volatility spillover increased from global and German benchmarks to European markets. Baele 2005 hinted at an increased intensity in the volatility spillover for the EU equity market throughout the 1980s and 90s. Lauses 2013 found the equity market to be the largest transmitter of volatility spillover even during the recent Eurozone sovereign debt crisis. MacDonald et al. 2018 found that the direction and intensity of the spillover effect is time-dependent. Tribelsa and Mida 2018 found contagion between all observed markets during the financial crisis. However, during the sovereign debt crisis, contagion was limited to 2 markets, Greece and Portugal. Although most academics' papers have used the variance-bound test to analyze the efficiency of markets and assets. However, Fakhri 2016, 2018 states that in truth the variance-bound test is a test of the stable market precondition hypothesis. The Eurozone market's stability have been a key subject in recent years due to the crisis. Since evidence of the stability of the market is in the efficiency of the market, hence we could use the papers on market efficiency to gauge the stability status. There is mixed evidence of the stability of the market. In a number of collaborations, Fackery and Richter 2015, 2016 A, B, 2018 and Fackery et al. 2016, 2017 found mixed evidence of market stability. The importance of a stable environment underpinning the Eurozone financial markets was underlined during the crisis period, as illustrated by any number of researches during the last few years such as Gruber et al. 2013, MacDonald et al. 2018 and Trabelsi and Midder 2018. The impact of volatility, spillover and contagion of news from one market to the other market within the Eurozone is a hot debate that is just as relevant today as it was during the recent crises and Euro introductory periods. Therefore, we extend the volatility test proposed by Fackery and Richter 2016 to a bivariate volatility test using an ABEKK model proposed by Engel and Kroner 1995, based on a benchmark market, the Euro Stoxx 50 index, plus 11 equity markets, allowing us to analyze news contagion, volatility, spillover and asymmetrical effect on the integration of the original 11 members of the Eurozone, across all 6 different observed periods of the Euro's timeline. The reasoning behind our choice of the ABEKK is the restrictions of the other GARCH models in order to guarantee the positivity of the conditional covariance, thus rendering our results unusable. In order to overcome these restrictions, we chose to use the unrestricted BEKK model. However, the big issue with using any unrestricted BEKK model is the large number of parameters and thus computing power required. In a normal BEKK, each coefficient matrices have a n times n number of parameters, plus a C matrix has n plus 1 times n, all divided by 2 parameters, and lastly there are the n parameters, for the mean equation. However, we are using the more complicated ABEKK which adds an asymmetrical matrix, D, with n times n parameters. With this number of parameters, it is highly likely that one reason why the unrestricted ABEKK has been used sparingly in econometric research is the sheer computing power it requires. Another possible issue with the unrestricted ABEKK is the difficulty to get convergence. The single lag ABEKK 1, 1 would be modeled using the equations and matrix system illustrated on this slide. The mean equation is calculated using the mean of the benchmark Euro Stoxx market and the mean of the observed Eurozone equity market. The conditional covariance, h at time, t, is estimated using a conditional covariance, h at time, t minus 1. The constant term, matrix C. The coefficient of the conditional residuals or ARCH, matrix A. The coefficient of the conditional covariance or GARCH, matrix B. The coefficient of the asymmetrical effect, matrix D. The V at time t minus 1 is calculated from the conditional residuals where U is the conditional residuals at time t minus 1. The coefficients of the ABEKK model of volatility are also key to our multivariate volatility test. It is essential to note that like Fackery 2019, we use our volatility test to analyze whether the market is stable or volatile. As mentioned earlier in this section, we derive our stability test by using the F statistics. For our observed samples, the F statistics at the 5% level is 1.96. We calculate our stability test statistics using equations as the stability status of the transmission. Since as stated earlier, we are only interested in the transmission of volatility from the benchmark Euro market to market N and vice versa, thus we only use the off-diagonal matrices. Like the univariate volatility test of Fackery and Richter 2016, our multivariate volatility test consists of 3 coefficients, A, B, and D matrices representing the news contagion, volatility spillover and asymmetrical effects. However, since we are analyzing a multivariate model of volatility, we use a 2-factor denominator representing the standard deviations of the Euro benchmark and Eurozone markets. Essentially, this paper analyzes the stability of the integrated equity markets from the 11 original Eurozone members, to establish the impact of key periods in the life of the Euro on the Eurozone financial markets against a Eurozone benchmark market. Hence, we use daily prices from the 11 equity markets listed plus the Euro Stoxx 50 as the benchmark equity market obtained from investing.com. As with the norm, we chose to use a 5-day week, filling the missing data with the last known prices. With the exception of the Portuguese SI 20 index, all the 11 remaining markets were observed between the 31st of December 1997 and the 31st of December 2018, meaning a total of 5,479 observations. However, the Portuguese SI 20 index was observed from the 4th of January 1999, making a total of 5,216 observations. It must be noted that, like all indices, the observed equity markets are based on weighted ratios of their components' prices. In common with many researchers using the volatility test, such as Fackery and Richter 2018, we use the modifier of 25 on the prices to overcome an issue with the variance calculations. As highlighted on slide 4, during the pre-euro period the markets were split between nervousness and enthusiasm about the introduction of the euro. Another key factor to bear in mind is the uncertainty brought about by the Russian default and LTCM crisis during the latter half of 1998. As illustrated by the table, the coefficients seem to be hinting, for A in green, for the transmission of news, there were ratios of 8:2 for the Eurostoxx and 3:7 for the sovereign equity markets. For B in orange, for the volatility spillover, there were ratios of 6:4 for the Eurostoxx and 4:6 for the sovereign equity markets. For D in turquoise, for the transmission of bad news, there were ratios of 5:5 for the Eurostoxx and 6:4 for the sovereign equity markets. The stability status in gold, for the market being stable during the transmission, there were ratios of 6:4 for the Eurostoxx and 7:3 for the sovereign equity markets. As partly illustrated by slide 4, during the euro introductory period the general consensus was that the euro did improve the environment in the Eurozone financial markets. A key factor to bear in mind is the uncertainty brought about by the start of the War on Terror and accountancy crisis during the early 2000s. As illustrated by the table, the coefficients seem to be hinting, for A in green, for the transmission of news, there were ratios of 5:6 for both Eurostoxx and sovereign equity markets. For B in orange, for the volatility spillover, there were ratios of 6:5 for the Eurostoxx and 4:7 for the sovereign equity markets. For D in turquoise, for the transmission of bad news, there were ratios of 7:4 for the Eurostoxx and 5:6 for the sovereign equity markets. The stability status in gold, for the market being stable during the transmission, there were ratios of 8:3 for the Eurostoxx and 9:2 for the sovereign equity markets. During the mid-2000s global bull market period, the global financial markets experienced a huge rise, none more so than the housing market and associated assets. Furthermore, the equity markets including the Eurozone markets were also experiencing a hike in the prices. A key factor to bear in mind is the uncertainty brought about by the continuation of the War on Terror. As illustrated by the table, the coefficients seem to be hinting, for A in green, for the transmission of news, there were ratios of 3:8 for the Eurostoxx and 4:7 for the sovereign equity markets. For B in orange, for the volatility spillover, there were ratios of 7:4 for the Eurostoxx and 5:6 for the sovereign equity markets. For D in turquoise, for the transmission of bad news, there were ratios of 6:5 for both markets. The stability status in gold, for the market being stable during the transmission, there were ratios of 6:5 for the Eurostoxx and 5:6 for the sovereign equity markets. During the late 2000s global financial crisis period, the financial sector experienced a highly volatile and uncertain period. This was initiated by the issues in the mortgage-backed trusts which led to huge pressures on the banking sector. As the financial crisis grew the credit market froze, hence the crisis spread to the corporate bonds and more importantly the equity including the Eurozone markets. As with any large financial crisis, a recession inevitably occurs. Generally, the recession in the Eurozone lasted from Q1 2008 to Q2 2009. However, some countries were affected more than others, i.e. the GIPS nations. As illustrated by the table, the coefficients seem to be hinting, for A in green, for the transmission of news, there were ratios of 8:3 for the Eurostoxx and 2:9 for the sovereign equity markets. For B in orange, for the volatility spillover, there were ratios of 9:2 for the Eurostoxx and 4:7 for the sovereign equity markets. For D in turquoise, for the transmission of bad news, there were ratios of 8:3 for the Eurostoxx and 5:6 for the sovereign equity markets. The stability status in gold, for the market being stable during the transmission, there were ratios of 8:3 for the Eurostoxx and 10:1 for the sovereign equity markets. The sovereign debt crisis started with the Greek revision of the deficit statistics on the 5th of November 2009, gradually becoming a widespread issue of confidence in global fiscal policies enveloping a number of Eurozone nations, especially the GIPS nations. The crisis reached the US with the deficit/debt ceiling crises which closed the US federal government. The impact from the sovereign debt crisis led to a double-dip recession in the Eurozone from 2011 Q3 to 2013 Q1, although for some Eurozone countries this was just a continuation of the recession that followed the global financial crisis. As illustrated by the table, the coefficients seem to be hinting, for A in green, for the transmission of news, there were ratios of 8:3 for the Euro stocks and 2:9 for the sovereign equity markets. For B, in orange, for the volatility spillover, there were ratios of 9:2 for the Euro stocks and 5:6 for the sovereign equity markets. For D, in turquoise, for the transmission of bad news, there were ratios of 5:6 for the Euro stocks and 3:8 for the sovereign equity markets. The stability status, in gold, for the market being stable during the transmission, there were ratios of 3:8 for the Euro stocks and 8:3 for the sovereign equity markets. The threat of the populist movements to European integration is a key debate, so we reserve some time for this issue. The rise of the populist movements is seen as a threat to the further integration of the EU and Eurozone economies and financial markets. The underlying influences of the Brexit results and prospective Exit have been attributed to the populist movement in both the UK and Italy, caused by deep issues. In particular, as the Franco-German axis is a driving force behind European integration, the rise in popularity and strength of National Rally, an anti-integration party, in France, could be seen as a weakness in the future push to further integration. Moreover, the European Parliament elections in May 2014 was a watershed event for this rise. Although many disagree with the significance of the 2014 European Parliament elections, yet we use the day after the elections, the 26th of May, as a start date of our observation. Furthermore, there is continued impact from the Brexit vote on the Eurozone equity markets, as the UK and EU struggle to get a workable agreement that would suit both sides, and more importantly get approval from both parliaments. In the wake of the 23rd of June 2016 Brexit vote, global equity markets lost over $2 trillion. The reaction on the 24th of June 2016 of the Eurozone equity markets illustrated the shock wave to the Brexit vote. With the exception of Finland, the losses were greater than 5%, meaning an average of 8.17% across all 12 observed Eurozone equity markets. With the current draft agreement in the balance, the continued dysfunction at the heart of the British government looked likely to negatively impact on the global and hence the Eurozone equity markets in the short run. Moreover, an additional impact on the integration of the Eurozone came on the 1st of October 2017 when Catalonia held a referendum on independence from Spain. The turnout was only 43%, resulting in a 90.2% vote for independence against 7.8%. The Spanish government declared the referendum illegal. This was not the only bid for independence within the European Union. In 2014 the UK government agreed a referendum on Scottish independence. The turnout was 99.91%, resulting in a 55.3% win for the Unionists. However, with the Brexit results, many in Scotland feel there is a need to hold a new referendum. Furthermore, there are other regions within the EU and in particular the Eurozone who are calling for independence. Following on this table illustrates the effect of the rise of the populist movements. As illustrated by the table, the coefficients seem to be hinting, for A, in green, for the transmission of news, there were ratios of 7:4 for the Euro stocks and 2:9 for the sovereign equity markets. For B, in orange, for the volatility spillover, there were ratios of 7:4 for the Euro stocks and 5:6 for the sovereign equity markets. For D, in turquoise, for the transmission of bad news, there were ratios of 3:8 for both the Euro stocks and sovereign equity markets. The stability status, in gold, for the market being stable during the transmission, there were ratios of 4:7 for the Euro stocks and 5:6 for the sovereign equity markets. Surprisingly, our findings seem to be hinting at generally news and volatility seem to travel from the Eurozone to the sovereign equity market. Conversely, the results of our stable market precondition hypothesis seem to suggest, generally with the exception of 2 observed periods, the underlying market environment is stable. Unsurprisingly, the 2 exceptions occur when the markets either massively underreact, as in the case of the bull market period, or massively overreact, like during the sovereign debt crisis within the Eurozone. Our empirical results point to differences in the reaction of market participants, which hints at the time and space effect. This seemed to be suggesting that the Eurozone equity markets were never truly integrated in the sense of the econometrics definition. However, this does not mean that the Eurozone equity markets were not integrated in accordance with the definition of Baele et al. 2004. What is without doubt is the reactions of market participants depends on 2 factors, the time and market of the event as illustrated earlier, hence the time and space effect. This is what drives the Eurozone equity markets integration, especially during highly volatile and uncertain times. We also reviewed the literature on the integration of the Eurozone equity markets in the aftermath of the introduction of the euro. We found most of the past empirical and literature pointed to an acceleration of the integration in the aftermath of the euro's introduction and during the bull market. However, this was slowed down in the aftermath of both crises. Although, the literature does point to the sovereign debt crisis having a bigger impact than the financial crisis. Nevertheless, The real danger is in the rise of the populist and nationalist movements across Europe, which depending on the views could result in the disintegration of the EU and thus the Eurozone. The case of Brexit and the resulting deal will no doubt be watched carefully with the potential of others to follow suit. There are already signs that the Italians want out. A relevant factor to emerge from the Brexit and 2014 European Union parliamentary elections is that many people don't fully understand the workings and fundamental concept of the European Union. Hence, many on the opposing view are able to significantly highlight the weaknesses of the European Union. This points to a lack of communication by the European Union Parliament. We therefore advise the European Union Parliament to communicate more with the population in order to raise the awareness of the work and concept of the European Union. Another issue raised was the loss of a sense of national identity, therefore pushing a significant number to extreme nationalists. Although, I am a supporter of European integration. However, a policy of slower-paced integration would be of benefit to most considering the rise in nationalist views within the European Union and Eurozone. A key issue raised by the recent crises is the miscommunication and disjointed actions by key politicians, which resulted in the financial markets being highly volatile and overreactive. We recommend the setup of a committee to oversee the communication and actions, especially during any future crisis, which would help to stabilize the Eurozone financial markets and therefore lead to a more integrated financial market. This concludes our presentation. Hope you enjoyed it.